Introduction to Financial Services, Accounting and Auditing Regulatory Structure, U.S. and International. Updated January 4, 2021. This in focus provides an overview of how accounting and auditing standards are created and regulated in the private sector, the federal government, and state and local governments. Different accounting and auditing standards evolved in the private and public sector to address the specific needs of their respective stakeholders. This in focus also discusses two policy issues that might be of interest to Congress and investors. Private sector. The private sector includes public and private companies as well as not-for-profit organizations. The accounting and auditing standards created for publicly traded firms are subject to the Securities and Exchange Commission's (SEC's) oversight. Federal securities laws require public companies, both domestic and foreign, to share critical information about their performance on an ongoing basis with investors, regulators, and other stakeholders. The companies are required to submit annual reports providing a comprehensive overview of their performance, including their audited financial statements. Accounting. Throughout its history, the SEC has relied on the private sector to establish and develop generally accepted accounting principles (GAAP) in the United States. GAAP are a common set of principles and practices to measure and report the economic activities of an organization. Currently, the SEC recognizes the Financial Accounting Standards Board (FASB) as the designated organization for establishing GAAP for the private sector. Auditing. Private and public sector stakeholders need to have reasonable assurance that an entity's financial statements are free of material misstatement, whether caused by error or fraud. In the private sector, independent assurance to shareholders and other stakeholders is provided by a qualified external party, an auditor. The auditor is engaged to give an unbiased professional opinion on whether the financial statements and related disclosures are fairly stated in all material respects for a given period of time in accordance with GAAP. Generally Accepted Auditing Standards (GAAS) provide standards of practice on how an audit should be conducted. The Sarbanes-Oxley Act of 2002 (PL 107-204) created the Public Company Accounting Oversight Board (PCAOB) as a self-regulatory organization to provide independent oversight of audits of public companies. The PCAOB also oversees the brokers and dealers' audits, including compliance reports. The SEC has oversight authority over the PCAOB and approves the board's rules, standards, and budget. Material misstatement in financial reporting can be defined as misleading information on a financial statement that could potentially affect a reader's investment decisions or conclusions about the financial status of a firm. Federal government. The financial statements of the U.S. government and its agencies provide taxpayers and Congress a comprehensive view of how the government manages tax revenue and how effective the federal government is at providing services. The financial report of the United States government serves the same basic purpose as the annual report issued by a publicly traded company to its investors. Accounting. The accounting standards established by the Federal Accounting Standards Advisory Board (FASAB) are considered GAAP for federal financial reporting entities. FASAB was created by the Government Accountability Office (GAO), an independent, nonpartisan agency of Congress, Department of the Treasury, and the Office of Management and Budget. Auditing. The financial statements of federal agencies in the U.S. government are audited by inspectors general, independent accounting firms, or GAO. GAO issues the Generally Accepted Government Auditing Standards (GAGAS), also commonly known as the Yellow Book, which provide a framework for conducting audits. Some audit organizations within the federal government use a hybrid method of external and internal auditors. State and local governments. The Comprehensive Annual Financial Report (CAFR), issued by a state or local jurisdiction serves the same purpose as the annual report issued by a publicly traded company to its investors. States and territories have the flexibility to choose the accounting and auditing standards that suit their needs. Accounting. The voluntary standard-setting body for state and local governments' accounting standards is the Governmental Accounting Standards Board (GASB). Although the SEC requires publicly traded companies to follow the accounting standards created by FASB, state and municipal governments are not required to follow accounting standards promulgated by GASB. States and municipalities can voluntarily adopt GASB accounting standards without any changes, choose not to adopt a specific standard, or modify a standard to meet their specific needs. Auditing. State and municipal government audits are conducted by either an elected or appointed auditor. Elected auditors conduct their work at all levels of government, from states to cities and towns. Appointed auditors are often appointed by the legislature or by the chief executive of the respective municipal organization with the consent of the legislature. State and municipal auditors might follow GAGAS or other audit standards that meet their specific needs. Policy issues. 2 policy issues might be of particular interest to Congress and investors. The first is the limits encountered by PCAOB to inspect the work of foreign accounting audit firms that audit the foreign firms listed on the U.S. exchanges. The second is the newly emerging sustainability accounting standards for businesses, which encompass environmental, social, and governance (ESG) issues. PCAOB inspection limits. Foreign firms accessing U.S. capital markets use foreign auditors from their home countries to audit their financial records. Over the past decade, the SEC and the PCAOB have entered into various agreements either multilaterally or bilaterally with various foreign regulators, but they face limitations with regulators in certain countries. For example, the PCAOB is restricted from inspecting the audit work and practices of PCAOB-registered accounting firms in China, including Hong Kong, to the extent their audit clients have operations in China. U.S. exchanges list 217 Chinese companies with $2.2 trillion in combined market capitalization. Of these Chinese-listed companies, 13 are national-level state-owned enterprises. Although other major U.S. exchanges continue to provide information identifying foreign-headquartered companies, NASDAQ stopped providing such information as of February 25, 2019. In the 116th Congress, the Senate passed S. 945, the Holding Foreign Companies Accountable Act, and a companion bill, H.R. 7000, was introduced in the House but not acted on. These bills would have required that foreign companies listed in U.S. stock exchanges be subject to the same accounting and audit oversight as listed domestic companies. These proposals would require increased disclosure about noncompliance by the foreign firms listed on U.S. exchanges and eventual delisting. Other similar proposals, such as S. 1731, H.R. 3124, and H.R. 7181, were also introduced. In the 116th Congress, members also introduced S. 2791, H.R. 5018, and H.R. 6614, which would have required the Federal Thrift Savings Plan to divest from foreign companies listed in the United States if PCAOB were unable to inspect the audit work papers of their foreign accounting firms. Some members have also expressed concerns about the SEC's oversight of the PCAOB and the culture within the board. ESG Disclosures. The investing community and various stakeholders, institutional and individual investors, academics, and advocacy groups, continue to engage in a long-running debate about what should be disclosed by public firms. Issues related to sustainability accounting standards have been at the forefront of that debate. Shareholder expectations for corporations to address material ESG issues have continued to increase. In alignment with these increasing shareholder expectations, firms with nearly $80 trillion in collective assets under management have indicated they will consider ESG issues, such as political spending, climate change, leadership diversity, and human rights, in the investment management decision-making process. The Sustainability Accounting Standards Board (SASB), a U.S.-based nonprofit, has created a set of standards to help corporations address increased shareholder interest in ESG issues. Currently, corporate filers with the SEC are not required to follow standards as recommended by SASB. Publicly traded firms are subject to certain other ESG-related disclosure requirements, for example, GAAP disclosure requirements, though these disclosure requirements might not be as relevant for investors' decisions as compared with those proposed by SASB or other standards developers. Congress could continue to allow companies to voluntarily choose to disclose ESG issues, require companies to disclose ESG issues, or make it harder for institutional investors to call for ESG disclosures. To address certain ESG issues in the 116th Congress, members introduced H.R. 1018, H.R. 3279, H.R. 4329, and S. 592. Proponents of ESG disclosures suggest that investments in material issues can increase shareholder value by differentiating among competitors within each industry, fostering investor confidence, increasing employee trust and loyalty, and increasing access to capital, among other things. Critics argue that existing regulations address many of the ESG issues or allow issuers to voluntarily disclose. Additional disclosures and reporting requirements, they say, could be an unnecessary regulatory burden for firms and distract firms from increasing shareholder value. CRS Resources. CRS Report R44894, Accounting and Auditing Regulatory Structure, U.S. and International, by Raj Nanaraja. CRS in Focus IF 11221, Introduction to Financial Services, Corporate Governance, by Raj Nanaraja and Gary Shorter. CRS in Focus IF 11256, SEC Securities Disclosure, Background and Policy Issues, by Eva Su. Raj Nanaraja, Analyst in Financial Economics.